Let's get started talking about building a trading plan. Now, I've given you a handout tonight, which you can please click on and download right now, because you cannot get this any other time or any other place. And download it to whatever device you're using now, and then you can move it to where you need it later, but you won't have any access to it in the recorded version of this class. Now, in order to become a successful trader, you need to develop a written trading plan where you put all necessary trading rules. Basically, a trading plan is your trading Bible. There is no such thing as the ultimate trading plan because there are no two exact same traders. And every trade and every trader has a different trading style, strategy, risk tolerance levels, and market experience. It is always better to develop one's own personalized trading plan and modify it as your experience grows. So think of your trading plan as a checklist. It will keep you on the right course and make sure that you've done all your correct checking once you've decided to make a trade, or will help you make your decision to make a trade and make sure you've gone through all the things you have in your head so that you don't overlook something or make a mistake. So just think of it as a checklist. Now, there's many things that should be incorporated into your trading plan. And the first thing everybody's going to ask me is, can you give us a sample? Can you give us a format? And unfortunately, I can't. I've looked all over the internet to find some type of a formula or format or a simplistic way of giving you this, but there isn't, because everybody's is unique. And the ones that are just use a table or somebody else's don't give you anything, because they're all about writing and taking that stuff you have in your head and putting it into some format. Now, you should begin your trading plan with your trading strategy, because everybody has some type of strategy. And it's the first thing and the easiest thing for you to put on paper. So if you're trading price action setups or off key structure levels, like you're trading off of support and resistance levels, or you're trading off of triangles, okay, put it down in black and white. Because when you actually write it down, think about it, you'll find all the fine points that you forgot, or all the gaps that you should be looking at. You find out when you write it actually down, you need to fill in a lot of blanks. So this will act as a blueprint for what you need to do each time you interact with the markets. You firstly need to backtest your strategies. You need to make sure you have them all cleaned up and right. Now, in addition to your strategies, you need to put in your risk tolerance and your money management rules. Because ultimately, risk tolerance and money management are much more important than making a simple decision as to whether to trade something to go up or go down. Having written strategies with your risk tolerance and money management is like having a market blueprint. This blueprint is essential for developing a discipline that will lead you on the road to success. If you find yourself not following your rules in your trading plan, then you are deviating from your plan, and you will eventually make too many mistakes and end up losing your investments and your portfolio. Now, some of the things to isolate or keep you on the right course is, once you've got your strategies down, decide what assets you're willing to trade. One of the biggest problems we have gotten, or we've seen developing over the last few years, is that with online trading, especially CFDs, you have hundreds and hundreds and hundreds of assets available to be traded. You know, it used to be years ago, if you wanted to trade stocks, you went to your stockbroker. If you wanted to trade bonds, you went to your bond broker. If you wanted to trade Forex, you went to a Forex broker. If you want to trade futures, you had to go to a futures broker. So it kept you limited in what you were trading. But CFDs opened the door to everything. Then on top of it, online trading brought everything together. And then we ended up getting all of these computerized tools that allow you to get information, do technical analysis, and make trading decisions very quickly. Which is, I mean, I've seen people who are making 20 and 30 trades a day. And we're not talking about high frequency traders. It's just you have everything at your fingertips. So one of the most important things to put in your trading plan is what assets you are going to trade, and be specific. You know, you can't say I'm going to trade stocks, because you know what? There's hundreds and hundreds of stocks covering every sector you imaginable. You can't just say I'm going to trade Forex, because you can't be an expert on that many currencies. You can't be watching that many economic events and that many headlines and doing that kind of analysis on that many assets. So maybe you say you're going to trade the euro, US dollar, the pound. You trade, the eight major crosses against the dollar. Okay? But put it in your trading plan. It'll help you from getting off track, because all of us want to trade Apple when it's in the news. All of us want to trade Google when it's in the news, and we all want to trade Bitcoin when it's in the news. But you just can't. Now, the other thing is you need to have a routine to your trading activities. Okay. And you need to have a routine to your entire trading business. Okay. Now, in your part of your trading plan, should incorporate what is your pre-market phase. Before I even go on to an online platform, I look at the economics calendar day. I review the charts for the assets I'm trading. I set the support and resistance levels for where the assets are at this point. I look at the current trend lines, okay, before I even get ready to think about trading. Okay. But that's me. You don't have to do what I do. Then you go over to your trading phase, and your actual trading phase should be very short. Okay. And your trading phase should not be every day of the week, all day long. Because you know what? You can't be an expert on that many hours of trading. Maybe you only want to trade the euro US dollar as it overlaps from the European to the US session. Because each session and each part of the day has different personalities. The assets react differently. I mean, if you took a look at what gold does in the Asian session to how gold reacts during the move over from the Asian session to the European session, you would be surprised, and you can find opportunities by knowing the personalities there. And then lastly, you have your post-market phase. And your post-market phase is a matter of record keeping and analysis. And this is very, very important, because it's going to help you decide whether you're making good trades or bad trades. Because a good trade isn't necessarily a trade you made money on, and a bad trade isn't necessarily a trade you lost money on. So make sure you maintain a trading journal which has the logs of all of your trades. This is important because it allows you to analyze your trades and the success of the plan adopted by you. It should include the entry date, the entry price, the exit price, the stop and limit and total profit and loss. And final notes, which is the most important, on your personal notes on each trade. Because actually, no matter what platform you're using, you can download your portfolio. You can download all of your transactions right into or export it right into an Excel spreadsheet. But it's your notes that's important. Why did I make that decision? How did that decision come out? Was it right or was it wrong? What did I see? So next time I need to go trade this, or I see this developing, I can refer back to this previous trade. Now, your daily routines are also crucial. And, I know a lot of you are sitting out there saying, this guy's full of mumbo jumbo. I'm not going to do this. This isn't what it's all about. But the fact is, creating a trading plan is highly useful as it reduces the possibility of bad or irrational decisions. If you have a written trading plan, then you have a trading filter that will filter only high probability trading opportunities. Because what you want to do is you want to filter out all the gunk and all the garbage, all those trades that you might have maybe made you a couple dollars, but you didn't see the trade that'll make you a couple $100 because you were so busy with all of these not high probability trading opportunities. It's important to have a written plan because in order to keep a high level of discipline and all of this stuff juggling around, you need to have it in black and white. Now, this doesn't mean written on paper. You guys, you can do Excel spreadsheets. You can put it together any which way you want. You can have a big Excel workbook. You look at my desk, I have sticky notes and index cards. Because back in my day, we used index cards to keep track of everything. The key to discipline and objective trading is to establish a trading plan and stick to it. Now, I know. I've been teaching this class for years. And if I ask 100 traders to send me a copy of their trading plan, just a general one, nothing personal, just show me what you put on paper. Show me what you use every day. Guess what? I won't get any. I don't think in all of my life anybody's ever sent me one. Now, if you want to invest your money or want to trade and make profit, you either have to be a serious trader or you can be a joker. And unfortunately, the reason you see that 78% people trading CFDs lose their money is because they're jokers. And I know you're saying, again, this guy's a jerk. Okay. But the fact is, if you're a businessman and you wanted to open up a retail store in the shopping mall and you had a good creative idea, how are you going to do anything if you didn't start a business plan? When you go to the bank and want to borrow that investment money, or you go to your friends or your family because you need that $100,000 or $200,000 you need to get it rolling, even if you're coming up with an idea for an app, okay, you want to open up an online website. Okay. I've met lots of guys that tell me I have a business proposal for you, and I say, okay, send it to me. Oh, I can't. Can we have coffee and I'll explain it to you? No. If you can't put it on a piece of paper, I don't want to know about it. Now, the fact is, that's your first piece of paper. That's just a little business summary that might get me interested. Okay. But then I say, okay, I'll give you, some of the money. Okay. But I want to see a more intricate plan. I want to see, return on investment. I want to see sales. I want to see it all broken down. Okay. You've got to start building a business plan. Okay. When you go to the bank and want to borrow the money, or you go to the landlord and want to rent that store and he wants to see a full business proposal or you need to go get that capital equipment and they want to see a plan to see if it's even worth them bothering, giving you the credit line. No. It takes time to build a business, start a business, kick a business off. But this is what trading is. It is your business. It is your new business. You're a trader. And this is what you do. Instead of developing an app or doing an online web, an e-commerce shop, you're doing a trade. You're doing a trader. That's a business. Now, there are already a million articles on the web about trading plans. But what separates tonight, what I'm telling you, and the rest is I'm going to try to show you, I'm trying to give you the points that you should include in your trading plan. So in most lines of business, time is the main driver for evaluating performance. Everything is, if you're, own a corporation, a public corporation, you have to report quarterly. If you're going to borrow money or get money, well, not borrow from the bank because they don't need to say anything, but they need payments. But if you're going to get your parents and your neighbors and your friends to invest in your business, they're going to want to know monthly how you're doing. You're going to have to report to somebody. You can't just take this and ignore the world. So companies report on quarterly basis to the street. Now, they would love, I'm sure Google would love not to spend all that time and effort of reporting every bit of information and every financial thing to the public, and then getting ridiculed if something went wrong. But if you're going to have a business, you need to. Now, the fact is, in our business, which is online trading, time is irrelevant because your money's in your portfolio. There's always a trade. So, if you sit down, you spend more time on your business plan, you don't do trading till next month, the money didn't go away. You don't have overhead expenses. It's not like you're paying development costs. You're not paying electricity. You're not paying rental. You're not paying for inventory. So trading is one of the few areas in this realm where the space-time continuum has no relevance. So you can't say to me, okay, guess what? I don't have the time to do all that because that's a waste of my time because I can be trading and making money. There's always going to be another trade. So one of the key matrices here is how and when you stop to evaluate how you're doing. Now, for me, I use every 10 trades and I stop everything after 10 trades are over and I do all my paperwork, all my analysis, I do everything. And then, and until I do, my rule of thumb is I cannot go back and make an 11th trade. I got to go make trade number 1 again. Okay. Now, that's only for me. That number isn't a guide for you. Okay. Now, this applies to both my swing trading and my day trading activities because on me, on an average, it will take me approximately 3 months to place 10 swing trades and about 4 days to place 10 day trades. So once a week, I'm sitting down and doing my evaluation. I only mentioned the time element so you can see how long it takes me to place that number of trades based on my trading style. If you're a guy who spends a lot of time trading and makes a lot of trades, you know what? You don't want to say 10 trades and that's every day and a half, and you spend more time just doing analysis because you just won't do it. So what is the number of trades you'll use when evaluating your trading activity? Now also, use the keep it simple stupid plan. Okay. Find an easy method in which you will evaluate yourself. Don't make it overly complicated. I've got these 10 trades. What did I do? What did I use? How did it go? Okay. And each time your strategy failed, why did it fail? Were each of those success trades successful? Like I said, a successful trade isn't necessarily one you made money on. If you had put your stop loss correctly, the market moved against you, got out of the market with a very small loss. That's still a very good trade because your rules worked. Now, another thing you have to think about is what time of day will you trade? I mentioned earlier, and how many hours a day you would trade. Because if you think you've got to do these pre-market activities and these post-market activities, and you've got to do all of this analysis stuff, you don't really have that much time to trade. So all of a sudden you've limited the amount of trades you're making. And this is very, very important because too many of you guys are making way too many trades. And if you spend your time doing all this work, limited the assets you're trading, limited the time of day you're trading, force yourself to do your proper analysis and write up your trading plan, you'll find you're too busy. You'll find a number of trades you're making is slipping. But what's happening is you'll also be filtering out all of those low probability trades and remaining with those high probability successful trades. And as I mentioned, make sure you define your trading edge, what your strategy is, whether you're going to use breakouts or whether you're going to use volume, whether you're going to use support and resistance. Okay. But develop a standard methodology for identifying the plays that you'll trade. Now, we already talked about identify the assets to trade. Because remember, goals are very important. A goal without a plan is just a wish. And that's what most of you do. You wish. You hope and pray, you make a trade, and you hope you make money. Now, whether it's using support and resistance, whether it's using different strategies, whether it's using crossovers, whatever you decide to use, put it down, but don't make it overcomplicated. Okay. Put down how you're going to calculate your stop loss. Okay. Now, it's very, very important because a stop loss will keep you from losing your money. But to integrate your stop loss, you also have to be prepared, okay, applying your risk management and your profit and loss ratio. Because when you do that, you find out, oh, technically I need to place my stop loss here, but my risk reward ratio makes it up here. Well, that's too high because I'm going to get stopped out. So therefore, I can't make this trade. And also, are you going to use guaranteed stop losses, trailing stop losses? How are you going to exit the market if it's moving against you? Maybe you want to, if you see it's not doing what you want, maybe you want to close half your position. You'll find, and you need to evaluate your stop losses. You'll find that if your stop losses are consistently being hit, then you need to take a deeper look at the volatility of what you're trading and your risk reward ratio and how much the position sizes you're taking, because you need to evaluate this as well as evaluating your trade. And then an important thing is when to exit the market and how to exit the market. Again, keep it simple. The exit strategy be as simple as when the asset crosses below a moving average or that an indicator moves into an overbought or oversold territory. Whatever it is, define your trading plan, because yes, we're going to set our risk reward ratio, and you're going to set a buy, a stop loss and a take profit level. But you need to be watching the market. And when certain things happen, you need to be exiting a market, not just waiting for it to keep going up. Maybe you want to use trailing stop losses, move your stop loss up closer. But all of this is important. And if you write it down and you have sections, how are my stop losses going to work? How am I going to analyze it? You have what assets, and you have it almost like an outline and a guide, and you can go step by step to the sections. You'll find that you're reaching this critical success factors. They're keys to your success. Okay. Now, another question is, or another thing you should incorporate under your risk management is your money management. How much of your money will you risk per trade? How much of your portfolio size? Just because you say, okay, I'm going to trade $500 per trade. Well, maybe you've had a bad month and your portfolio has gone down from $10,000 to $5,000. Well, maybe you should be reducing the amount per trade. Okay. And limit the damage to your account balance. Okay. Now, another crucial factor is when to take breaks. Okay. Again, you're going to say this guy's an old ditty. This isn't how the real world works, but it is. This is how that 22% of long-term successful traders survive. At some given point, and you come up with the number, you need to exercise your control of the market. This means after 100 trades, so in my case, okay, that's 10 weeks. I take a complete day off. And we're talking about a holiday, and I'm not going on vacation. It's just a day I don't look at assets. I don't go on my platform. I don't deal with anything, because what you're doing is you're saying, well, that sounds goofy. It isn't. You need to take back control and discipline. And by doing this and forcing yourself away, you're exercising your discipline over the markets. Another thing you should incorporate is what you'll do when the markets are going in your favor or against you. So for me, if I lose 2% of my trading capital at any point during the day, I close all my positions, I take my losses, and I walk away, I go fishing. On the other hand, if I've had a good trade early in the morning and I picked up 7.5%, okay, I close all my other positions, I take my profit, and again, I go away. And reason to do this is if you've had a very good trading session in the morning, okay, or your first trade is doing extremely well, you tend to get cocky. And when you get cocky, you make trades you shouldn't make. So take your profit, close your positions, close your trade online, and come back tomorrow. You've done well. On the other hand, when you've had trades are not going well for you that day, you tend to get annoyed, you tend to get aggravated, you tend to chase trades, you tend to let them hang in there too long. So you know what? Just close your positions, walk away, and come back with a fresh head. Now, on your screen, and I think in your handout, I gave you this simple trading method. It's the only one I could really find on the internet. Okay. And I don't see any benefit to this one. It's too small. Okay. Imagine a business plan. Okay. What you do is you start out with your one pager. Then from there, you start writing it up, because at some point, your investors want to see actual how much money you need, what you're going to do with that money, how you're going to, and how at what points you're going to use it, how you're going to judge it. Then you get ready to open your online store. Okay. Do you have all the right products? What product categories? Where's your analysis? Okay. Maybe you're spending so much money on marketing, you don't realize that all these ads you're buying from Google with all these keywords aren't bringing you back any money, but these other 3 keywords or these 3 Facebook ads are bringing you tons of money. Well, if you're not doing your analysis, guess what? In 6 months, you have no more money, and you wasted all of that money on Google ads when it was the Facebook ads that were successful. So you need to be constantly doing everything and anything it requires to operate a business, because trading is your business. So start out simple. Start out with a simple trade. Just start writing the things down. Start keeping a log of your trades. And you don't have to write your whole plan to start today. You just simply add to it. Okay. But what you have to do is you have to start limiting your assets today. Start developing your money management rules today. Start doing your analysis today. Okay. But you can keep writing it up later and later and later. Okay. And you'd be surprised, over a course of a couple months, you'll have this big, beautiful whole plan laid out. Like I said, you can have sections. You can have my analysis section. You can have my pre-markets. And you work on each one. You can have a big Excel workbook and you have it all laid out in sections. But think again, if you think about your online trading as a business and not as just, oh, I can log in and trade money, I can make money today. Think of it as a business, and think of it as a long-term business. You'll find that you can turn it into profit. And that's ultimately what's important. Too many people don't want to do the writing. They don't want to do the analysis. They don't want to write up the trading plans. They just want to have, oh, I know how to do this, this, and this, and okay, I'm going to look at this chart. I mean, I spend more of my time during the day charting and doing analysis on I only trade a half dozen assets, okay, than anything else. Okay, as you see, I told you, I do 10 trades in 4 days, and that's if the markets are busy. That's little bits of nothing. So hopefully the handout I gave you will help you along that route. And again, if you open up a demo account at TradeTime, www.tradetime.com, their financial analysts will work with you one-on-one, directly with you, and help you set up your own and get you off on the right foot. So thank you very much for joining us this evening. And I hope I gave you some points. I'm not trying to tell you what you have to do. I'm not trying to tell you I'm right. I'm just telling you, when I started, this is what my mentor hollered at me all the time. Okay. And I'm just trying to push it along because I know, look, I have got my undergraduate degree in accounting, my MBA in taxation and finance. And I know over the years how many people would come to me with business ideas, like I said, not trading ideas, business ideas. And I'd say to them, go back and write it up. You know what? You never see them again because they just didn't want to write it up. And it's the hard work of trading. It's not the fun, enjoyable part of trading. But if you think about each time you trade and you trade successfully, and every month that you made money, everything you did for that month was enjoyable and successful. I had rewards. If football players can go practice every day and learn every play in every book, okay, for that one reward of the 2 hours of play on Sunday, maybe they get stuck on the bench the whole time. But they still have to write up and learn every one of those plays, have it all in order, have it all worked out. Okay. So put your time and effort into it, and hopefully a year from now you can say, oh, that really worked for me. Thank you very much for joining us. And again, go to www.tradetime.com. You can also watch a recorded version of this class by using the same link you used to come to tonight's class, or in a week or two, it'll be edited and available on investing.com's website. Thank you very much and have a great trading life. Bye now.